In the next series of lessons, we're going to talk about gaps, when there's a big gap between the previous day's price and today's price. And what does that mean, and how could we trade these to our advantage? And there are some definite opportunities with trading gaps. In fact, some people primarily trade them. They only focus on trading gaps. So we're going to talk about that in the next coming lesson, and that could be very interesting. You might find, like, if you've ever traveled like through light rail or something like that, the separation between the platform and the actual train, there's like that little gap between that, and you have to step over that, and it tells you to mine the gap, right? So it's kind of the same thing with technical trading, which is when a gap appears, you have to take a look at that. You have to be cognizant of it because something significant could be coming on. So whether you're taking the train or technical trading, either way, it's very important to mine the gap. So let's talk about, well, what do we mean by gaps and when there's a gap or not a gap? So how do we use gaps to our advantage? Because they could be really terrific trading opportunities. The key is to differentiate between what is a common gap and an uncommon gap. So let's look at those here briefly. A common gap is something that can occur in either a trending or non-trending environment. It doesn't really matter. And a common gap doesn't change the trend or start a new trend. It's just common. Nothing's really going on. There's a gap, yes, but it's not going to make a big difference. It's not going to change the trend or start a new trend. Those are the things we're really looking for. It's simply noise. Nothing's going on. It might be a little flutter up or something like that because some announcement or rumor or something that happens. And a lot of times when you see these common gaps, they're not impactful. It occurs when the trading volume is low, right? There's less people trading. So a good way to kind of verify if something might be a common or uncommon gap is by simply looking at the volume. If the volume levels are low, there's a very good chance it's a common gap versus something like an uncommon gap, which we're going to talk about next, where it's very significant, versus a common gap, which would be considered not significant. So if that volume is high and there's a gap, then you might have something that's real significant, which is an uncommon gap. And that could lead to a big price rise or fall in the coming days or weeks. So an uncommon gap is a significant event that is occurring that may impact the price and trend and provide a great trading opportunity. So what we're really looking for is the uncommon gap. And there's 4 key ones to really look at, and those are the breakaway gaps, runaway gaps, exhaustion gaps, and island reversals. So in the next lesson, we're going to go through each of those individually and show you how to watch for them, how to recognize them, and how to trade them to make some profits off of those types of gaps that can occur. Now, gaps are actually rare things. That's why they make a great trading opportunity because, something unusual has happened. There's been some significant event or significant news, and it's caused a gap in the prices. So if you look at this example here, you can see like days 1, 2, 3, and 4. And by the way, this could be whatever time period you prefer. It could be on minutes, hours, or whatever whatever you generally use. We'll just use days here to kind of keep it simple. But in particular, you're really looking at those opening and closing prices. That's really more of the classic formation of a gap, is looking at an overall day's trading range. And so days 1, 2, 3, and 4, you can see there's overlap between each of the ranges of bars. I don't have the opening and close on here because that's not important when you're looking at a gap. You're looking at the range from the high to low, and you can see there's overlap from days 1 through 4. But then on day 5, there's a gap. You can see that there's a space in between the highest high of the range from day 4 and the lowest low on day 5. So there's no overlap between them, and that would give us a gap situation. Now, you can identify a gap at the start of a day because by nature, for a gap to occur, the opening price is going to have to occur somewhere in a void, somewhere above the trading range of the day before. So you could say, oh, this is something, there's something going on here. You could kind of tell that by the opening. You need a gap at the opening for sure. But you can't measure a gap until the day is over because it could open as a gap, but then let's say in this example here, the prices actually fall and that bar got longer on day 5 going downward, where it then turned out that there was overlap. If there's any overlap at all, there's no gap. There has to be a gap in terms of no overlap. That's the key thing to take away. So that's why you can't tell until the end of the day whether there's a gap situation that occurs. And then we're going to need to wait a little bit longer, as you'll see coming up, to confirm that gap and that it's a trading opportunity. But for now, no overlap. It could open in a gap situation, but it has to close in a gap situation. And we're really looking at the highs and the lows. And so you're measuring from yesterday's high to today's low. That would be an example of an upside gap. There's space or air between yesterday's high and today's low, or from yesterday's low to today's high, where there would be a downside gap. So there's upside gaps and then downside gaps. So if you were to look at this example here on the right, what would you think that is? Is that an upside gap, or would that be a downside gap? And it looks like it's going upward, so if you guess that, you're right. But yeah, yesterday's high does not match up to or does not overlap today's low. So there's a gap in between the two. By the same token, if we looked at this image, you'd see a downside gap where, yesterday's low does not overlap today's high. There's a space in between them. And so there can be either an upside gap or a downside gap. Gaps can go either way, up or down. And what we have going on here is you have a void. You have this space, and what's going on is there's no match of buyers and sellers. They're out of equilibrium. There's no match with regards to if somebody's looking to buy or sell at a certain price range within that gap area. So there's a gap between the two price ranges between the 2 days. In this example here, prices had to go upward to form a match. So there may have been people trying to sell just a little bit above, the day before, or maybe below, or somewhere within the range of that day. But something happened, whether it been good news or some sort of announcement that triggered everybody to now feel that they're not going to sell that low. You're going to have to pay me more in order for me to sell. So the prices rise, and you could see that gap that formed between the 2 days. So there may have been some really good news overnight that had caused that price to jump up and create that gap. So that's what's happening. In this example, it could have been opposite. It could have been a downside gap, but in this upside gap, you could see that there was some news overnight. Prices jumped up and right before the opening, and the first opening bid, so to speak, or trade is well above the overlap range. There's a gap in between. So that's how you understand gaps, and what you're looking for is basically you're looking for space in this void between two trading periods, or between 2 days. Okay, breakaway gaps. These are very, very important. And what happens when there's a breakaway gap is it's going to bring in a lot of new traders, add volume. That's one way you could tell if it's an uncommon or an important type of gap. You're going to see that volume increase. It's going to bring in a new audience of traders. And it's usually driven off of some type of big event, or maybe some earnings announcement, some sort of news, that something that's happening that's really driving the impact on that security to cause that gap, which could be up or down, but it's a big gap that frequently marks the start of a new trend. When you have a breakaway gap, and I'm going to show you that visually in just a moment here, but when you have one, that can mark the start of a new trend. There's major change coming. There's major change that you're going to see visually on your chart. You might start to see the daily trading range start to widen, or you might see an increase in daily volatility with lots of things being sold high and low all throughout the day. Also, we mentioned that much higher trading volume is a good indicator that a breakaway gap is occurring. And when a breakaway gap is occurring, it's going through a significant support or resistance level confirming it. So your support level would be the low prices, and resistance would be high prices. And somehow it's breaking through one of those, this trading range of prices. And that's why we call it a breakaway gap. So you're breaking through a significant support or resistance level while gapping up or down, while on a pickup in volume. So those are the three variables you're going to want to look for. And it's a significant leap in terms of price. And we'll take a look at that now and how to trade one here visually. So in this example, we have an upward gap, right? We have a gap between days 4 and 5. And what you're really looking for is a couple things. Ideally, for a breakaway gap, you want it to be really proportionally big in terms of the trading range. So, for example, if the normal range is, let's say, $3 or whatever the currency is that you're using, and the gap is $15 as far as between the preceding day's high and low, and the gap day opens up higher than that, then that might tell you that something significant is going on. There's a big gap in between the prices, and the more significant the gap, the more impactful that is, and more likely that you might have a true breakaway gap. Again, we have to wait till the end of the day to really confirm that it's a gap, that it doesn't just come down in price and kind of fill that gap and just overlap the previous day. If we look at this, we have this proportionally big gap in terms of the trading range. There's a big jump up in terms of what was going on before between days 4 and 5. And you can see it in the preceding days kind of confirm that as well. And also, to really identify a breakaway gap, know they happen when price is only slightly trending or moving sideways. There's not really much that's going on, and then all of a sudden, boom, it just happens. It's not like there's some big massive trend and then we have this little breakaway gap, but it's already part of a massive trend. That's not a true breakaway gap. They don't happen while you're already in a trend. That would be considered a different type of gap that we're going to learn in the next lesson, but it's not a breakaway gap. But if you look at like here in this example, you could see where prices on day 1 and 2, 3, and 4, they're up and down. There's no significant trend, or it's kind of just moving sideways. And then there's this big leap up. If anything, you might say that between days 2 and 4, there may have been a little bit of a downtrend. And then all of a sudden, it just kind of went boom. There's that big gap upwards to day 5, and something caused that. So when you're looking at the interpretation of these, let's look at this one here. This is an example of an upside gap, as we know. So something happened, some good news creates demand, and people want that stock badly or the security badly, and they're willing to pay higher prices to get it. Volume is typically noticeably higher than usual if we were to put volume along the bottom of this chart, and we will look at some other charts later and you'll see that. But if we had volume here, you'd usually see a spike or dramatic increase in volume because people see there's some good news overnight and they really want to get involved. And because of that, they're willing to pay, higher prices for that stock or security at the start of the day. And that's what helped create this big upside gap. Another way of looking at a breakaway gap, of course, is a downside gap. And what that means is the current security holders, they just want to get out of it. They just want to dump that security, sell it, and they're even willing to accept even lower prices to do that. They're willing to go even lower than whatever the low of the previous day was. They just want out. And volume, again, is usually, but not always, but usually abnormally high in this case as well. Again, there's some kind of event, something happening, and there's a mass movement either up or down. In this case, this would be a downside breakaway gap where there's been a significant kind of move here to sell the security. So either way, you're looking for these gaps and you're looking for these significant moves for a breakaway gap as opposed to other gaps we're going to learn about. Another gap, of course, that's really important is a runaway gap. And they're very, very important because it relates to the continuation of a trend when you have this type of gap. And if you think about it, what's the difference between a breakaway and a runaway gap is a breakaway gap is the breaking away. It's breaking away from a previous trend and starting a new trend. Whereas a runaway gap is one where it's continuing the already previous trend. So you might have a breakaway gap that changes things and starts a brand new trend, a fresh trend, and the runaway reinforces that later and continues that trend. And perhaps you would want to maybe look at that as an opportunity to add to a position to continue to ride that trend if it were to be in an upward trend. And you could have an upward or downward trend that a runaway gap occurs in, but the idea is it's not creating a new trend. A runaway gap is continuing an existing trend. And that means there may be even more news coming out or something that's building onto this, and there's a fear of missing out or FOMO, so it's created this big leap, let's say, in pricing. So let's take a look at runaway gaps and how to recognize them and talk about the trading opportunities that they offer. So if we look at our example here, you can see how over this time period there was a breakaway gap, and then that started a new trend, which happens to be in an uptrend. Then there's a little sideways movement that follows, and then we have another gap around days 11 and 12, and that would be considered a runaway gap. And that's once again a runaway gap because it's continuing a previous trend. It's the second gap that occurred, whereas that first gap was our breakaway gap, and that's the one that's kind of altering the previous trend and creating that new trend. So if we were to look at this in a different way here, you could see that the black line shows that trend from the previous breakaway gap starting on day 5, and then we have a little bit of a pullback, which is normal. People will buy that dip. We had that little trend of 3 days. People sell a little bit, maybe some profit taking, then some new buyers step in. So that all goes down, and then the new buyers come back in and reinforce that trend. And so we have that buying on the dip when it kind of dips down for a pullback for a day or two, maybe 3 or 4, and then we have more of a movement back towards the upside to continue the uptrend. So then we have that big gap between days 11 and 12, and that's the runaway gap. So you're really just reinforcing the continuation of that trend with that form of gap. So it's very normal, natural to have a little bit of a pullback. So you want to be watching for that. So we would be looking forward to days 13 and going forward that the trend we had seen before would keep going. And that's really a good buy sign. If it was the opposite way, it would be a good sell sign should we have been in like a downward trend. But in this case, example we were using, we could see that we had our breakaway gap. We had a little bit of a pullback. Now we've had our runaway gap and we're still going and we're still doing well, continuing with this trend and getting some profits there. Now this exhausted pug is an accurate representation of what we're going to talk about next, which is an exhaustion gap, when price starts to run out of steam. So what is an exhaustion gap? Well, it's all part of these uncommon gaps that we've been talking about, but the exhaustion gap specifically occurs at the end of a trend. And really what they're signaling is things are going to start changing, or that party is over basically. It's starting to end and we're getting exhausted. And what's being exhausted is the news or whatever happened to propel the energy of the early buyers that drove that security up in the first place. Let's say if we were in an uptrend. So you might have had a breakaway gap that changed the trend and made it go up, which may have been followed by a runaway gap that continued that trend, building onto that momentum. But at some point, it runs out of steam and has maybe another gap up in prices where you see what's called an exhaustion gap. You know, it's kind of like that one last buyer after, you know, a buying frenzy is over, the guy that's just late to the party. So let's look at the exhaustion gap in relation to what we've been looking at in the other types of gaps. So if we continue with this chart pattern here, you see we talked about our breakaway gap and we talked about our runaway gap. The breakaway gap is what creates that initial trend, and the runaway gap is what continues it, kind of adds fuel, so to speak. But when that trend starts to run out of steam and we have an exhaustion gap here, we have kind of that last buyer or group of buyers jumping in, creating that new gap. You know, they're thinking everything about this stock is so exciting. You know, the trend's great. Let's drive these prices even higher. And everyone's kind of like, that's not it. You know, you're late, buddy. And you see where they start to kind of run out of steam there, and you start having what would become an exhaustion gap where you have that gap, and then you'll see on day 16 what follows is we have overlap. So that price comes right back down, leaving a gap in between that day 15 low and that day 16 high, forming what's called that exhaustion gap. One way you could tell with that too, you know, how do we know if it's an exhaustion gap versus a runaway gap, or how to be aware of that? Because, you know, maybe that exhaustion gap is just another runaway gap. And the main characteristic, the main variable that changes is with an exhaustion gap, you're going to be moving up on very low volume. It's going to be lackluster volume relative to what it's been previously. Where with a runaway gap, you're going to see huge volume pouring in. It's going to be way above average relative to what you would normally see on a daily basis. So you think about your volume, how many people are actually trading the stock? If we look at the bottom of this here, you could see on day 12 where we had that real high spike in volume. That means a lot of people want to get involved in the security, and that's what's causing that price to be driven up. And then that kind of continues from there, where if you see a gap like this, which is going to become an exhaustion gap, you're going to see where you have your gap, but then you see that that volume is actually pretty low on a relative basis. Again, that's an indicator that there's, in this example, less buyers out there. There's a couple, you know, last ones who are willing to pay these premium prices, but it's kind of really running out of steam and becoming exhausted. There's far less interest in the name. So that means that the party's over, so to speak, right? And so you're now going to have some overlap. You're going to, you know, potentially start moving sideways in that stock security, or maybe even start to reverse and form a downtrend. So when you're trying to decide, am I looking at potentially a runaway gap or an exhaustion gap, look at the volume there on the particular security leading up to this. So, and if you see a spike in volume that is way above average that occurred with the gap, then that gap in this case could be a runaway gap or a breakaway gap. But with an exhaustion gap, that volume is lethargic. It's going to be very low, and that's very telling when there's already an established trend, and it's signaling that that trend is coming to an end. So it's imperative that you're watching that volume when you're trying to dictate what type of gap am I looking at. Is it a runaway gap, breakaway gap, or an exhaustion gap? And how is it going to affect the current trend, or is it going to start a new trend? So if we look at this island here, you might say, well, that's a nice looking island. It would be a nice, beach to relax on. But what if I told you there was nobody there and there was no food, no water, and nobody was coming to help you? It wouldn't be such a great place after all, right? And that's essentially what island reversals are the majority of the time. They're just not a great place to be, but they can be a very strong indicator to show what's going to happen next. So they're rare, they rarely occur, but when they do, they're a very, very strong indicator and can provide a great opportunity. So if you see an island reversal, you really want to pay attention to it. And they form with a combination of gaps, with the first being an exhaustion gap, that final hoorah, as we learned about, and it's going to have this gap followed immediately by a breakaway gap to the opposite direction the following day. So what you're finding is that whichever way that breakaway gap then is the next day, that last trader kind of finds themselves all alone on that island, and they need to start adjusting their price either up or down to kind of get back in step with the people who are willing to buy or trade or buy or sell with them. So let's take a look at these island reversals and how to recognize them in a more understandable graphic manner. So to identify these island reversals, you're going to need an exhaustion gap, right? And so we know from day 14 and 15 that we're possibly looking at an exhaustion gap. We saw that our volume was lethargic, it was low. We should have had a real spike in volume there should that trend have continued, but it actually went down in terms of volume between those days. And so we know we're running out of steam, and that is our exhaustion gap. And then what will happen is you'll now start seeing overlapping bars, and price might start going sideways. It might even start going down. Basically, it's showing you that trend has been broken at that point, and it's not trending upward anymore, as in this example. The classic island reversal is going to happen the next day after the previous gap up. So some traders will say that you might have 1 or 2 trading periods in between, but really the classic definition of an island reversal is a gap followed by another gap to the opposite direction. So as you can see in this example, on days 15 and 16, you have that gap up, and then from 16 to 17, that gap right back down, completely reversing the momentum. So you look at day 14 to day 15, we had that gap, and we identified it to be an exhaustion gap because the volume was very low. And then we had another gap from day 15 to day 16, and that volume becomes even more lethargic, and there's even less volume, or doesn't necessarily need to have less volume, but there's low volume on a relative basis versus the average. And that's basically telling you that there's far less buyers at that point in time than there is on an average basis. So there's really not anything there to hold that price up. And then we see on day 17, we have our island reversal, and we close down with a big spike in volume. And from days 16 to day 17, that island reversal is, well, day 16 is the island, right? It's that island that there's very few people on. And then from day 16 to day 17, you gap back down, and that's what's called the runaway gap, right? So you can have the runaway gap going up or down, but from day 16 to 17, you have your runaway gap on that pickup in volume. So that trend is clearly changing. So the time to sell or buy depends on the island, as I mentioned. So if we look on the left here, you could see that this was an upward trend that was exhausted. Then it jumped from days 15 to 16 to form that island. And then what we're doing is we're waiting to see what happens on day 17. And that's really what's going to confirm that we're on an island and that it didn't continue going up or something like that. It was an actual true island reversal after an exhaustion. And you can see now prices have come down and there's another gap in between. But a lot of volume is coming in now. People are aggressively selling. They're really trying to get out, as you could see in this example on the left. So that's now created a new downward trend on an island reversal. So it's time to sell. You got to get out, book profits, book the profits that we made from day 1 through 16. If we were staying in the whole time or however long, but we were in the stock at that time, and right now is the time to get out. By the same token, if you look on the other side, where if you look at day 13, 14, and 15, things have been trending. We haven't bought yet because it's in a downtrend. There's an exhaustion gap from previous runaway gaps and breakaway gaps that have led to a strong trend going downward. Prices are going down. We see the exhaustion gap between days 14 and 15, and we see that on day 16, following that exhaustion gap, that we formed a nice little island there. We're going to watch to see what happens on day 17. What happens on day 17? The price goes back up significantly. We see that high volume. We see that we have an island reversal, but actually it's going in the other direction. We want to buy on that. So now we're seeing a new uptrend that is forming, and this would be a great buy signal, kind of confirming with that volume that we have an island reversal going in the opposite direction. So the key point is you don't know if it's an island until that second gap occurs. It's day 17 in this example. You might see it jump out way ahead after an exhaustion gap and kind of guess like, oh, is that a reversal? And it could be, but you really need to look at the volume and you really need to confirm the following day. Others will guess based solely on the volume. If it's low volume, they might say, oh, on day 16, the volume was very low, and that could potentially be setting up for an island reversal. And that's not a bad guess, actually, but to be a true island reversal, to get your confirmation, and what conservative traders are going to be looking for is you're going to need that day 17, as you can see in this example. So there's high volume there. It's really established that, yes, things have changed. That's a definite change, and now you can see that there's a new trend forming. So to really look at a classic completed island, you'll have to have that exhaustion gap with low volume, followed by an island gap with low volume, and then you're going to have that breakaway gap in the opposite direction on high volume, which is going to then, obviously form your island. So you got to make sure you're not on that island. You get off that island, you get involved with that new trend, depending which way it's headed. So those are island reversals. They're actually very rare occurrences, but when you see one or spot one on, when looking at charts, you're really going to want to watch it close because they're very, very strong indicators, probably because they are so rare and there's so many requirements behind them, right? With the exhaustion gap, the strong trends coming beforehand, either up and down. So watch for island reversals and be ready to strike. Nothing's perfect, of course, but this is a very good indicator, but this is a very strong indicator, and make sure you check those volume levels to kind of confirm what you're seeing is truly happening.